Good evening, everyone. Yes. And welcome. Thank you, and welcome to Venture New York. As many of you know, or maybe you don't, Venture New York is a two-day event bringing together investors, entrepreneurs, and ecosystem leaders to connect, learn, and explore the evolving venture landscape across New York State. From emerging managers to seasoned investors, this event offers the opportunity to gain insights, build relationships, clearly as many of you are already doing, and discover high-quality deal flow rooted in the region. Before we get started, I'd like to thank our Venture New York sponsors. I'm going to try to zip through this. We couldn't do this without you, but SUNY Research Foundation, thank you so much. New York Ventures, Woods Oviatt Gilman, Phillips Lytle, Griffiths Institute, Upstate Medical Biotech Accelerator, Fuse Hub, Launch New York, and NextCore. Also, our New York State Business Plan Competition, which, as you see, is being set up for tomorrow. We have SUNY RF, Levrix, Chet and Karen Opelka, Business for Good, Right to Start, Homefield Funding Partners, and our annual sponsors that support Upstate Capital throughout the year: New York Ventures, Woods Oviatt Gilman, SUNY Research Foundation, KeyBank, Hamilton Lane, Witham, Harder Seacrest Emory, Alpha Sense, Blue Hedge Capital Partners, Schwartz Heslin Group, and Seneca Holdings. Please give a round of applause. Now I'd like to welcome our host, Dr. Ian Mortimer. He's the founding president of the Golisano Institute for Business and Entrepreneurship. Founded in 2023, this institute delivers a high-quality, accelerated business education funded by billionaire philanthropist Tom Golisano. Recently, the institute announced an expansion in Buffalo and has expanded its focus to train professionals for leadership roles in AI adoption. Prior to founding the Golisano Institute, Ian served as the VP of Enrollment and Associate Provost for Continuing Education at RIT, where he led enrollment strategy and continuing education operations. So with that, please help me welcome Ian Mortimer.
Good evening, everyone. I'll be brief. I know we have a full agenda, but I just want to say, first of all, thank you for the opportunity to host this event. Tom is coming back from Florida May 5th, and so I'm kind of channeling what he would say if he were up here today before he gets back. And the reason this institute exists is a lot of the reasons that we're all here in this room together. You know, Tom built a pretty powerful corporation on the idea that Western New York can produce hardworking, very talented, entrepreneurial-minded individuals, and that's kind of what we do here. I want to thank Kathy Kayaza, Stephanie Ryan, the operations team, Jamar, and others for being able to pull this all together tonight. This is an after-hours venture, and so thanks to my colleagues for that. I just want to say a couple of things. One is that you know, what we have learned about our work so far is that business is different. You know, business requires reps, and business requires tech, and business requires sales, and business requires modeling and professional behaviors to kind of grow the workforce of the future. And when you come here tomorrow, I think what you'll see is 150 individuals that when they walk in the door, they're going to look and feel like professionals that already have jobs. They will be on time, which is something that we feel very important to kind of grooming the next part of the economy. And there are also individuals that are going to want to shake your hand, look you in the eye, and be interested as much about what you are doing as you may be about what they are doing. It's a very, very different brand of business education, and we're really proud of what Tom has afforded us the opportunity to build. Our vision is that within a couple of years, we're 1,000 students, about 400 here in Rochester, about 600 in Buffalo, where we're bookending the Western New York geography with all kinds of opportunities for students and all kinds of opportunities for employers and all kinds of opportunities for building business and having that start with youth, and that's the reason that we exist. So thank you to Shelby and team for allowing us to host this, and I hope you have a great evening and a wonderful day tomorrow. We look forward to seeing you then. Be well.
Thank you so much. And I also want to give credit to David Brown on our board from Impellant Ventures for making the connection with the Golisano Institute. It means a lot to us, and we really appreciate it. David Brown. So without further interruption, we are going to move into our first panel. How are investors really deploying capital right now inside the 2026 playbook? So with that, I don't need to read the panel description, but I'd like to introduce our panel, our moderator, Flossie Hall, Director of Operations at the NASDAQ Entrepreneurial Center. We have Rob Poltrino, local, Rochester man, Chief Operating Officer at Skull Diamond and Heart Capital. We also have Danielle Blunt. She's a staunch ecosystem champion from Buffalo, but she is also the partner at Bold Ventures. We have Rami Katz, CEO of Excel Partners. I could tell you a lot about Rami Katz, but catch me later. And Mike Steffen, the finance manager at Microsoft. Welcome.
Test now. Test. Good, good. Okay. Welcome. So excited to see you all and excited to be here. As Shelby mentioned, I'm Flossie Hall. I'm the National Director of Operations for NASDAQ's Entrepreneurial Center. For anybody that wants to learn more about what we do at the center, come find me afterwards. But I'm so excited to be here with a bunch of great investors from different industries and different backgrounds. As Shelby alluded, we have been in some turbulent times over the last couple of years in a couple of different shifting markets, from 2021 and 2022 and the COVID era to the post-COVID era. Fast forward to 2026, these three major funding milestones have looked completely different based on the economic and geopolitical landscape that we have. So Shelby, I know that you already introduced everybody, but I wanted to give a little bit more insight into what each of these great investors do, because they come from different types of funds. So Rob from Skull Diamond and Heart Capital is a Rochester-based pre-seed and seed fund, and they are unusual because they don't just write checks, they roll up their sleeves and they actually operate alongside their portfolio of food tech and ag tech. Danielle of Bold Ventures is a seed and seed stage fund investing fund across Great Lakes, upstate New York, and the Ohio corridor. One of the few funds that I know that has founder wellness structurally built into the model, which I love, and deliberate emphasis on backing diverse women, veteran founders in a region that's historically been under-leveraged by venture capital. We have Rami of Excel Partners, who just stepped up as CEO in January, so congratulations to Rami. Round of applause for that. Taking the reins of upstate New York's most active seed funds affiliated with U of R, RIT, Cornell Upstate, SUNY RF, and 20 years of deal flow behind it. So you can see lots of great expertise here. And Mike from Microsoft Finance, supporting M12, which is Microsoft's venture fund, bringing the portfolio analytics and capital discipline lens from inside a Fortune 10 balance sheet. So again, a round of applause for these absolute rock stars. All right, to start, this is going to be a speed round because we only have 30 minutes, and I was like, with this many panelists, how fast can we get through these questions? So keep that in mind, panelists. So 45 seconds or less. I would love each of you to answer, what is the single biggest mindset shift that you have seen across investors in 2026 as opposed to what we've seen in years past, COVID or post-COVID? And I don't mean in like actualization, but the actual mind shift of what you're seeing in your colleagues or in your own thesis. So Danielle, you want to get us started?
First of all, thank you, Shelby, for putting this together, and everyone for coming out tonight. I know it's a start of a long week for Rochester and Buffalo, so appreciate everyone. I'm using my 45 seconds up here quickly. But I think for the mindset is less hype. 2020 to 2022, there was a lot of dry powder and a lot of companies just getting insane valuations because everyone was worried about missing out on a deal. FOMO is a real thing, and I think now we're back to, is this a real business? Is there actual traction in here? Can they scale? And they're probably also not going to need as much capital because we have AI now. But, I think that's the shift of less hype, more real businesses that people are investing in.
Love it. Next, Mike, 45 seconds.
Yeah, and just to build on that, I think, everyone was kind of chasing these unrealized gains, TVPI, and kind of like you said, the FOMO. They didn't want to miss out on these high valuations in these rounds. And I think now we've kind of seen a mindset shift to demanding cash. And I think that investors want to see what's real. They want to see real revenue. They want to see real margins and kind of what that path to real free cash flow looks like. And so now we're rewarding proof and not necessarily just concept and the shift of, kind of what might be. And then as a result, I think that, the investors right now who are able to say no to 95% of the deals are going to be the ones who are successful in the long run.
Again, thank you for having me on the panel. I guess along the lines of what we heard, capital becomes more precious, so you have to have more dry powder. So we kind of bifurcated our thinking process. On the one hand, we wanted companies that are closer to break even, closer to the ability to generate their own cash to support of operations. But also looking at the long play, we actually went earlier towards the foundation and actually starting to co-found companies. Because my assumption, like anything, it's cyclical, it will go away. When the desert, 2021, you could sneeze on an investor, a check would appear. 23, you couldn't beg for cash, right? So we believe that this will go away, so we started going earlier for deals that start younger, put more resources, small amounts of cash, but more resources behind them, push them forward, so by the time they get ready to ask for a bigger check, the market will turn.
This is the beauty of going last. Everything that they just said, I would also say capital is patient capital now, a little bit more than it was before in agriculture. That's what I primarily invest in. I would also say just founder wellness, sort of what we were talking about before in your intro. We actually high touch with all of our portfolio companies. We have 45 active right now, and we talk to each one of them on at least a quarterly basis. So, helping where we can, rolling up the sleeves, engaging, expanding our team, providing more operational support, and really establishing where the gaps are with founders. They might be, fiscally really savvy or technically really savvy, but they're not the leader of people, or they can't give or take critical feedback. So while we can talk about how capital is deployed, we're looking for the right leaders, people that can be trained, people that can actually grow, that they know their limitations. They know when, okay, here I'm CEO now, I may not be CEO at this point, and they're okay with it. And the other thing I would just say is that 30% of all the rounds right now are down rounds, and that is definitely because of past investments that we've seen. We looked at a company today that their post-money valuation in their last round was $25 million. Their post-money in a round they're raising right now, which is $1.5 million, is $3 million. So those investors are getting slaughtered there. So we're very conscious of doing a full evaluation, starting and ending with leadership and all the normal due diligence.
Well, you answered one of my first questions, Rob, was what are the traits you're looking for in founders now? So you kind of went into that a little bit. So in the tighter market that you have, how do you evaluate that early stage risk right now?
Yeah, so there's 4 criteria that I sort of I lead with the first time I meet a founder, and they go in order of importance. So the first one is leadership. Who is the leadership team? What is their pedigree? Can they give and take critical feedback? Are they the leader of people, leader of projects, both? Are they not a leader at all? Are they a scientist, an academic, a combination? Where are they at? Can they attract and retain talent? Can they disseminate really technical jargon and for the layman? And so forth. So you could talk a lot about that. Do they know how to raise money? What's their experience? Go from there. The second thing I care about, and this is just in the first 5 minutes I'm doing this evaluation. The second thing I care about is what is their plan? Is it something on the back of a napkin, or is it the most fully built out deal room that has everything I could ever want to see in there? There's no wrong answer other than there's no plan. Just because you say no to somebody now doesn't mean they won't come back later if you give them honest feedback. The third thing I care about is sort of the product market fit. Are they solving a problem that their customer knows they have, don't know they have, there's competition for, not competition for, any combination between. And the last thing I care about in its entirety is what the product technology or service is. Because you can have the best product technology or service with the right customer and the right plan and poor leadership, and you fail. In fact, you can do everything right on this side, but if it doesn't start and end with leadership, it's not a fundable company in my mind.
I'm going to pivot over here to Danielle, who has a fund that invests in diverse portfolios, and we're friends because I love to also invest in underserved founders or underestimated founders. So with that market and with your thesis model, Valuations are resetting, LPs are tightening. Are you finding that it's harder or easier to underwrite in those markets?
Like with our focus?
Yeah.
No. Opportunity does not discriminate. So founders look like everyone about the world around us. I think deal flow is actually better. And we have one of our newest portfolio companies sitting up front. So, we're excited to be investing in Catherine and her team here at Playground. So, for us, the deal flow is there. It's getting out and looking for it and finding different founders and founders that are going to be scrappy, that are going to tough it out, and they're going to use their capital. And typically founders who have been underfunded that are women, minorities, veterans end up making that dollar go a lot further, especially in upstate New York and Ohio where we are focused. So for us, no, we are mission focused on our thesis, and I think our LPs have appreciated that.
I love it. Keep writing those checks. All right, Rami, with your background coming into this with 20 years of history and things being tight in the upstate New York geography, how is your sourcing strategy evolving in this tighter capital environment?
Is this your way of saying I'm old?
No, I'm saying you're experienced.
Thank you. So we rely heavily on our partners. We're very fortunate to have SUNY Research Foundation, Upstate Medical University, Rochester Institute of Technology, University of Rochester, and other academic partners that help us both evaluate deal flow and find deal flow. We're not limited to investing deals from the university, but we typically look at what we call deep tech and life sciences, so stuff that involves a lot of research. So eventually you will be touching some of the research points in the ecosystem. And normally they are aware of us, we are aware of them. We try to be good neighbors and come do office days, support entrepreneurs on their journey when they're thinking about the problem. So our presence is known in the region through that. And once somebody's developing something on a little bit more breakthrough in the research, usually we have enough kind people that refer them to us and we give them lunch.
I love all that. And I'm going to pick on Mike last, since we have some great regional partners here. Mike is the only strategic venture arm here on this panel and the only CFA. How does M12 think differently about capital deployment in this environment compared to a traditional fund? What is the Microsoft alignment test?
Yeah, I think it's really the dual mandate of the strategic arm where it's not purely strategic, it's not purely financial. I think at the end of the day, you need the strategic piece of it to enhance the financial returns, and they should go hand in hand. And so at Microsoft, I think we really have a more disciplined approach than many would expect. Even with such a large balance sheet and money to go around, that money can be allocated anywhere. And so for it to be allocated towards our venture investing is really it's a special thing where we don't take for granted. And then also at the end of the day, if we're not investing for financial returns, it's going to be R&D spend. It's not going to be venture investing. And so we really do have a disciplined approach where you kind of start with the strategic, the checkbox, and that allows us to look at it from a financial lens. It doesn't really work the other way around. If they don't meet those initial requirements that we're looking for that kind of fit our thesis areas, then they don't really make it to the next stage. And the great thing about being a strategic is we have so many experts within the company that we're able to turn to. And so we don't invest for those product groups or for those teams, but we're able to leverage our relationships and network within that to kind of get the first-hand experience on the technology, on the customers, the other areas in the space, and then we're able to build our thesis from there. So it's really a well-rounded system where everyone's able to benefit through these partnerships, and then we kind of have a customized, personalized experience for the portfolio companies where when they do enter the Microsoft ecosystem, we're able to help them expand and connect them with the right people from our kind of large base of product teams and commercial groups.
And as many of you know, capital also comes with resources and support systems and networks and those magic doors that you need opened in business. All right, Rob, where are you leaning in aggressively right now in food or ag, and where are you guys kind of pulling back and pausing?
Yeah, so we're taking a lot more what I guess we classify as deep tech ag, something that's a little bit of a departure from traditional ag. It may be AI and robotics, but it has some other special component to it. I used to say somewhat comically in the past that like the holy grail for me of things to invest in would be like a fully autonomous, strawberry picker, which goes through and says, oh, Wegmans needs 3 tons of strawberries, and in 4 days. And it's like, oh, I'm going to pick the ones that'll be ripe on the truck. In 3 days when they're delivered, they're perfect. Like those kinds of things. But really, we're looking at things that deal with inputs, things that deal with challenges to farmers that, contrary to popular belief, farmers are actually very progressive with technology. So, going out there, talking to farmers and really asking them like, hey, what is the problem you have? And then we're going out saying, do we know any companies out there that can solve that? Do we have anybody in our portfolio? Or, maybe we should be looking at that. So there's no simple answer there, unfortunately. It's really, ag is such a huge space, and there's so much that I guess you would call deep tech there. But really, we look at a lot with inputs, and a big push right now because of what's going on overseas is fertilizer prices. And we have 4 or 5 different portfolio companies right now that deal with inputs to extend the longevity of fertilizer or restrict its overuse. So we're actually seeing a huge uptick in that. But, would I invest more in that? No, because I think Rami said earlier, it's just like things are circular. Like it's going to slow down and have its ebbs and flows and things like that. So really what we're identifying is like, what's the next crisis? Water management, how farms using water, where they're getting it from, how are they testing it, pathogen resistance. We're looking more into, like, I don't know if anybody knows what chloroplast transformations are, but it's basically GMO, but in the chloroplast of a plant cell rather than the nucleus. There's so much you can look into, but ag is deep, and I guess we're more ag biotech these days.
Thank you for that. Rami, up next to you. I personally lived in Southern California for 10 years. I'm a New Yorker, though. Funding is completely different in upstate New York than it is outside of Boston, New York City, Palo Alto. What is it like in the landscape here in upstate New York, and what is still so hard about fundraising here?
So our standard joke is you can raise more in one breakfast in New York City than a month of fundraising in upstate New York, right? So that's a challenge, but it's also an opportunity because that means that founders have to be more scrappy and more innovative. We are blessed with a lot of strong institutions that provide support. So in lieu of capital, we have said, look at the 2 things. First of all, things, as one of the car dealerships has a slogan that says, things are cheaper in the country, right? So in that perspective, things are cheaper in upstate New York than in the city. We always joke that there's an extra 0 in the valuations of deals coming from the city, right? Because you can stretch the dollar much further in upstate New York, and that's a talent. So we rely on, we try to reverse a paradigm and use it kind of from the buyer or the acquirer perspective. So we work a lot of strategics. We have 2 hospital systems that our most active fund right now is a life sciences fund. We have 2 hospital systems that work with us, right? So we look at what can our clinicians do to help progress the company, and can the hospital systems be the first buyer of that, right? One of our portfolio companies is here is going through that discussion as well, because it serves an early validation for the company itself, right, which is a huge amplifier in terms of valuation or a meaningful milestone, but also the learning process, because it's a friendly buyer, they will not shut you down. They'll tell you, look, this doesn't work. You need to tweak to the left, you need to tweak to the right. So we are adding value to the company through that process and making sure that entrepreneurs are smarter. So it's kind of feeding both sides of the equation. I'm always shocked by the number of large strategic players that are flying in on a monthly basis to Rochester, Buffalo, Syracuse, right? It's like, you come here, why? Because this is where the technology is and the strength. The brilliance of the people that we have here is amazing and really unparalleled, and I think a lot of it is because we don't have the luxury of too much money and what we call SOS, shiny object syndrome. Oh, I can do this. Oh, I can do that. When you don't have money, you have to be focused on what you're doing.
And when I first moved back to upstate New York 4 years ago, Danielle was actually the first person that I met over LinkedIn. And I said, here's all the things I do, here's my work, how do I plug in? And she was one of the very first people that said, connect with this person, connect with this person. And I spent my first year having meetings and going to events, but it became a very small ecosystem very fast. So Danielle, as somebody who is such an incredible community builder, as founders are raising, Tell me about the importance of this ecosystem and the human capital of just networks, because in other areas like New York City or Silicon Valley, you're one of millions pitching, these investors, where here you can sit side by side with fund leaders. So tell me, like, how do you get in these rooms? How do you build these relationships?
I mean, be like Flossie, just ask.
Hi, I'm Flossie, be my friend.
Buffalo and like upstate New York is a living room. It doesn't take long to get to know everyone. But that being said, it's also a really small community. So sometimes I think mistakes get held against founders inadvertently because, I'll see Rami or I'll see Rob and then we're all talking about the same founder. So I always think like making sure you're making your best impression, but then always asking the question. We were just on with one of our portcos this afternoon, and she had a short list of 15 funds that she needed for this next round that she really wanted as like a marquee one. I think we got off of there and we're like, we can tick off about 7 of those. Like, just give it to us. So it was just her asking, but also coming with a really pointed ask. And I think, again, the only way Upstate gets better is if we all continue to work together to make the pie bigger and don't really get worried about like, this is my fiefdom and I'm gonna hold on to it. It's always, how can we work together? How should we partner? How do we share deal flow better and getting on calls with each other? So I think for us, this is where I work, this is where I live, and it's like, how can we always make it better? And we make it better by working together.
And I love the ecosystem here. It is like a nice little living room family. I think it's wonderful. All right, Mike, you sit on the portfolio analytics side over at M12. So what financial or portfolio signals are most important when M12 is deciding to double down on a company or hold off and pull back?
Yeah, I'll put my finance hat on for this one. But some of the things I like to look at is ARR, high level, but trends and kind of more specifically net new ARR and kind of the customer churn and how that is trending. A lot of times, especially early stage, we see that companies have their financial forecasts and they're forecasting their customer base and ARR and all these shiny new logos and everything, but they haven't even really gone through a renewal cycle. You haven't seen any churn, and they're kind of just assuming that they have the best product out there and that things are going to be great. So I think it's really being realistic about that, and encouraging the founders and the CEOs to be realistic about that. So kind of seeing how that's trending is a big piece of it to give us insight into the health of the business, because top line revenue may look okay, but things under the hood might not be trending the same way. I think another big piece of it is kind of cash runway and how their cash burn has been trending. Now, a lot of the good CEOs that we see are able to make decisions quickly, and they're allowed to be flexible. I think in this environment right now, we're seeing that a lot of things are changing on a weekly, monthly basis, especially with a lot of the new tools coming out, a lot of the new systems, and companies have to adapt. And the ones that are slower to adapt are the ones who are constantly coming back for more cash. Their runways are limited, and you're not as excited about putting that extra dollar in because they're going to be coming for 2 more in another month or 3 months' time. And then I think really the last piece of it is their exit path. Is there going to be any liquidity here? I think in the environment right now, I think we're starting to see some rebounding in some of the M&A markets, and the secondary market especially as well is now becoming kind of a structural piece of liquidity for funds. But the IPO market is still slow. I know there's a few big ones that might go out this year, but you don't know how that's going to react. I think 70% of unicorns that have went out to IPO last year went out at a down round to their last private round valuation. And so a big piece of it is, what is the exit path for this company? What is the way that we might possibly get money out, and is that worth doubling down? And if the answer is no, if we don't see a way that they're going to find that path, that best exit path, then it's going to be tough for us to want to double down. And then just to put the strategic lens on for a minute, I think a big piece of that is this company still strategic to us? Do they still provide value? Are we still getting extra partnerships? Are we still able to connect them, or kind of have we exhausted all options there? For us, it's not always about the financial return and kind of maximizing what that looks like, where kind of a traditional financial VC might, or they might follow on a little more aggressively. We're more disciplined in that approach, and the strategic fit still has to be there for us to continue to be committed.
How are we doing on time? Okay, so I have one last hot button question. Everything is AI now. Everybody's using Claude and ChatGPT, and I'm going to throw this question at whoever would like to answer it. But I've seen a lot of founders lately that can crank out a pitch deck, financial pro formas, clickable prototypes. They give you everything that they built in a day. How are you vetting through anything that has been just produced and regurgitated, a drafted pitch versus a company with substance, which I'm sure leans into needing to see more traction under the hood and those things. So how are you first cutting through any of the BS, so have you, and what kind of traction are you actually looking for to write those checks?
I mean, founders have also forgotten you can ask Claude to not use M dashes. So typically if I get an email that's full of those, I know AI wrote it. Talk to the team. I will talk to an entire founding team and a bunch of their members because I need to know, are you all going to sort of tell me the same story? Is everyone bought into the thesis? Is everyone bought into sort of where the ship is going? So getting on the phone or getting in the car and talking to the actual human is usually a way to cut through the BS. And in terms of traction, is someone paying for the product? Is someone renewing? Have we gone through the renewal cycle? And if all of a sudden you have 90% churn, you're not solving anyone's problem. You just spun up something that someone was willing to give you $10 for. We're out of the age of sort of the quick apps. So what is sort of the meaningful dollar amount? For us, we look at usually $500,000 to $1 million in revenue, because that means usually we've gone through a cycle or two, and we're getting that piece of it. But it's also just validating and talking to actual humans and not just doing everything over email and trusting everything they say.
I'll
Go
be
ahead,
quick.
go ahead.
I don't know if everybody here has ever read the book Spy the Lie, but I highly recommend it. But we can tell when something's written by AI, or it paints the brightest possible picture. And my favorite question to ask is why or how? How did you come up with these numbers? Go there and you just kind of ask a question, and then 5 minutes later just ask it slightly differently and see if you get the same answer. It's really that human interaction that's going to dictate whether or not they know what they're doing, but also what's the saying? If it's too good to be true, then it probably is. And my favorite question to ask is, wow, according to this, you're doing really well. Was $100,000 from me going to do to move the needle? And it's usually at that point they're like, oh, I don't know who I'm talking to and what they bring to the table. So it's clear that they didn't do their homework.
So even as it changes, you have something too, Rami. I mean, it's incredibly important to understand that it's still relational. You're still going to have to get on and talk to a human and validate and verify before somebody is willing to just write you a check, right?
This is very much a contact sport, right? So use AI as much as you want. The images will be prettier. In my mind, it's again bifurcation model. Either customer interactions, then I want to talk to the customers. If your AI fabricates customers, we'll find it out in due diligence. But the other side of it, the earlier side, it's really the data. Right? So if you published today, we saw a company published in Nature. Okay, if it's published in Nature, it's probably the science is very interesting, right? If you're not, right, I don't care what you tell me. Show me the test results. If it's done on one mouse, yeah, I don't care about it, right? So use AI as much as you want. Please do.
Okay, and we want to open it up for questions. Okay. Bring a mic around.
Stun them to silence.
Coffee or cocktails? Both? Coffee and cocktails? Anybody have any questions for this wonderful panel? You have some incredible investors up here. Take your opportunity.
Hi. So what if you're a founder with a early seed stage or pre-revenue company that's looking for funding? How would you want to get started on get out there?
You can build a lot with nothing now with a lot of tools. Get out there and prove that someone actually wants to pay for your thing before you start talking to VCs. So we are going to want to see real revenue before even at pre-seed now. We're going to see $1 billion 3 people companies. So figure out what tools are out there and start getting traction, because that is the thing that will sell your company either to someone to acquire it or to someone to write you a check.
I'll say it this way. Thomas Edison used to say, I don't invent things that people don't need. Somebody needs what you're saying, then find those people and have them speak on your behalf. Because the companies that come to us, none of them tells us, hey, we're providing stuff that sucks. Everybody tells us how wonderful this stuff is, right? but it's not what you think about your product, it's what whatever your solution and so whoever else that you're serving wants to say about it. And if they like it, they'll find you.
Yeah, I would say the other thing, and I agree with everybody here, I would just say that show up. Come to things like this, pull us aside, ask our opinion. It's like, hey, I'm not ready for funding yet, but this is what I'm doing. What do you recommend? Have you seen something like this before? Are there any pitfalls? Like, just be honest. And the best thing you can do is tell us how bad something is and where the gaps are, because that's where, really solid investors can come in and say, like, hey, here's where we can help you, or this is what we've seen, or, maybe there's an incubator, an accelerator we can point you to help you become a fundable company. I think you had said earlier just about community, like in Rochester, you can go up to one of us and we're not gonna be like, oh, sorry, we don't have time for you. We might say like, hey, I'm in the middle of something, here's my card, email me or reach out to so-and-so. So like, we're not unobtainable. You can just talk to us, we're just people, but I think all of us here would be fine with just communicating with each other on a daily basis. So I would just ask any founder, why wouldn't you do the same?
Yeah, just to add to that point exactly, I'm a boomerang. I left the area. I was born and raised in Buffalo. I left Buffalo after school. I moved out to Seattle for a few years to work at our headquarters, and then I came back when I got the opportunity. And since I've been back, I've been doing exactly what you're saying, trying to get myself involved in the network, meet people like all of you, and get myself in these kind of rooms and in front of these people. I was connected with Shelby, who's now connected me with a lot of other people, and everyone's just been super nice, super outgoing and helpful. And everyone here and in upstate New York and in this community wants to see the community grow. And so I think kind of putting that hat on and allowing yourself to get involved, get fully immersed, and just continue to meet new people and see where that takes you.
If we're meeting the cash flow development, say in the $500,000 to $1 million range, given the current economic situations that we're looking at, say the next 12 to 18 months and disruptions in the economy, what do you see as far as your investment caps that you're looking at as far as targeting for, say, seed or A rounds?
That to me, because I gave a dollar amount, which I probably shouldn't have. No, I'm just kidding. It's on our website. I mean, make sure I'm understanding this. Like, how much cash you need to raise, or
No, as far as looking at the readiness to initial capital investment that the VCs are looking at, as far as saying a few years ago they were throwing cash out at projects, over capitalizing. Now we see a pullback on that, but given where we are today, where's that comfort level? So if you're seeing a company that is approaching you for investment that's meeting your cash flow expectations as far as growing the business, what is the relative willing, as far as bandwidth for the organization or VC group for investing in and then following through with follow-on timeline for follow-up?
every fund's gonna be different. I'll speak to mine. So our first check, 250 to 500,000 typically in Ohio. We've reserved half of our fund for follow-on. So that was very poignant of like a plan when we started out that we wanted to follow on into winners. So it's asking the VC, what is your thesis? Do you follow on? There's a bunch that do pre-seed. They don't want to follow on. It's not part of what they do because they don't have the skill or the bandwidth when you're talking about a 50 or 60 portfolio company. Unless they got 100 people on their team, you're not like paying attention that much. But so I think asking them, and how much dry powder are they at? Look at their vintage year, see where they're at in their deployment schedule. This is all available on Crunchbase, PitchBook, wherever, and just figure out. And I always say if a VC is not honest with you about where they're at in their deployment schedule, it's probably not someone you want on your cap table. So just know the couple questions, and I'm happy to follow up afterwards and talk more.
And I'll say it this way, I think I 100% agree with Danielle. It's very variable by fund. I always suggest to entrepreneurs, most VC funds have a portfolio page. This is who we invested in, right? So find your sister or brother or whatever surrogate that you have in their portfolio. If you cannot see that in their portfolio, then maybe that's not the right fit for you. Still ask, right? But that's the easiest way to think about it, because it really varies. For us, our model is even slightly more complex. Excel will start with checks anywhere between $250,000 to about $1 million. We have some follow-on funding on top of that, but we also have a follow-on fund that is a private fund that I'm also part of the GP of, that will really, the entire fund is dedicated, part of the model is to follow on those investments. So it all varies about the structure that you have and you're dealing with.
Yeah, I mean, everybody hit the nail on the head here. It's all very different. So, you know, if I was looking at your deal, for example, I'm going to be really paying attention to like what use of funds is, what is that runway, is it reasonable? You know, all I know it's definitely wrong. Like but have you thought through it? Like, you're going to say, hey, I need X amount of dollars, but it's probably like X plus something. It's never X minus, and you think you're going to get it done this time. It's probably going to take a little bit longer. So before I was probably looking for, 18 or so months of runway. Now we're looking more like 18 to like 36 in terms of how can you do that? Because if you're raising an early stage round and maybe you're working on an MVP, you don't have that fully deployed yet, that time to get to an A, to get, much more capital in, it's gonna take longer. You're gonna have to, meet a lot more, kiss a lot more frogs, and very few will turn into princes. That's just sort of the nature of the game. Or princesses, or whatever your preference may be.